How to check if a stock is overvalued or undervalued. Welcome back to Wealth-ology. For today's video, we will be going to talk about how to check if a stock is overvalued or undervalued. Let's get started. How do you tell if the stock market is overvalued? Are prices too high? Should we wait for the market to decline, or is this truly a good time to enter? Is one of the most frequently asked questions by investors. And let's be honest, no one likes investing in the stock market only to see prices decline. So this is a crucial issue to ask. However, there are a number of signs that we may examine to ascertain whether the market is overvalued, or at the very least, to have a sense of where the market valuations stand. Method 1. The market PE ratio. You may actually obtain the market's overall PE ratio, and you can use this to determine whether something is overpriced. First, require a measurement of the entire market before calculating the market PE ratio. Currently, the S&P 500 index is used in the USA. The SP 500 gauges the performance of 500 extremely significant and well-known American firms. In essence, the entire USA market is drawn to this index. It is regarded as a standard for the entire market. So what we do is to obtain the index's price, also known as the average stock price, after which you make a comparison with the profits, aka how much money the stocks are making. Obviously, in terms of profit, cost against profit is the oldest comparative measure in the book, and it's easy to locate. All we have to do is conduct a standard internet search and visit the multiple.com website, which displays the following graph. As you can see, the S&P 500 PE ratio at the moment is 32.95, which is significantly higher than the average value. The PE ratio has been 15.85 on average throughout history. It's double that right now, which isn't encouraging. The PE ratio is roughly where it was in 1999, when the dot-com disaster was about to occur and the market PE was 32.9, which is similar to what it is now. This might imply that the market is now overvalued, but we need to look at other signs to corroborate this. Method 2. Shiller PE ratio. Investors have recently disputed the use of conventional PE ratio for market measurement. They claim that the figure is inaccurate because earnings in a given year might vary due to business cycles. Professor Robert Shiller invented the Shiller PE ratio in response to this and introduced it to the world. To account for inflation and eliminate the impact of market swings, he averaged the earnings over the previous 10 years. Consequently, many investors think it's a more accurate method of gauging the market. Anyway, the Shiller PE ratio today stands at 30.27, which is significantly higher than it has historically been. Over the previous 100 years or more, the Shiller PE ratio has generally been 16.75. At the moment this video is being made, it is therefore around 14 points higher than the average. Nonetheless, the average over the previous 20 years is 25.6. This makes things appear much more realistic. Method 3. Buffett indicator. Warren Buffett is regarded as the best investor of all time. He is also renowned for not enjoying to time the market. He only concentrates on purchasing high-quality businesses that are on sale. He does, however, employ one formula to assess the state of the market. He said in a Fortune magazine interview that it is probably the best single measure of where valuations stand at any given moment. The Buffett measure is a market capitalization of company equity divided by the GDP of the country. It effectively compares the overall stock prices to the amount of things that companies produce, or the gross domestic product. The Buffett indicator is currently at 171.7, which is high. It is higher than it was during the 2008 housing bubble disaster, and even higher than it was during the dot-com market catastrophe. As Buffett says, the indicator spiking before the dot-com crash should have been a very strong warning signal, and perhaps it should be the same thing today, because it implies that corporate equities are quite expensive when you look at the prices. The next step is to compare it to the GDP that these stocks are producing, aka how are you doing? The economy is not doing well. There is a significant difference between stock prices and the state of the economy, which is why the Buffett indicator shows such a high number. Method 4. Returns you get in the market versus other assets is the only surefire technique to tell if the market is overvalued or not. As a result of the comparison you're making between the results you can expect from the market and those from other asset types. In the end, comparable comparisons are necessary to determine whether anything is overvalued, and this method does just that. Let me clarify. The first thing we need to figure out is what kind of return we can expect from the market right now. And many novice investors will typically respond, "You can't figure that out." Well, using a straightforward math, you can. So, as you may recall, we earlier estimated the market PE. We'll require that number once more. In order to calculate the market price to earning ratio, which is 32.95 if your memory is strong, we need to take the inverse of that, which is earnings divided by price. Therefore, we can observe that earnings represent 3.03% of the price if we divide 1 by 32.95. Consequently, if you purchase shares on the market for $100, on average you'll get back $3.03 or 3.03%. Thus, the market returns is 3.03%. Nevertheless, the increase of these earnings is the only factor that is lacking from the equation. Everyone is aware that income will increase with time. Which aspect of this subject have you found to be very useful? Please let me know in the comment section below. And if you like this video, please give it a thumbs up. Turn on the notification bell and subscribe to our channel for more. Thank you for stopping by to watch. Stay tuned for our next video.